price keeps returning to the same place. That is the first condition that defines this environment. The chart looks active. Moves expand. Moves fail. Moves return. But the return is not random. It keeps happening near the same structural center. And on this chart, that center is very clear. It is the weekly 0.33 area. Recent session boxes keep forming around it. They form above it. They form below it. Then price comes back through it again. This is the first thing that matters in a session-centered framework. Time is not just the clock. Time is where one session hands structure to the next. And when several sessions keep handing structure back to the same place, that place gains weight. That is exactly what happened here. If someone followed this week through session boxes, the key was not guessing direction. The key was seeing where the next session was being forced to form. And the answer kept repeating. Back near prior session memory. Back near overlapping boundaries. Back near the weekly 0.33 area. That is why the structure on March 31st was not isolated. It was inherited. Now go one step deeper. The reason session boxes matter is not because a box itself is magical. It matters because the box shows where a session accepted trade long enough to define its own working range. And that working range rarely appears in empty space. It usually forms on top of earlier memory. Sometimes directly on a prior session boundary. Sometimes between two prior session boundaries. Sometimes across the upper edge of one session and the lower edge of another. When that happens repeatedly, compression builds. And compression is not a vague idea here. Compression means distance gets reduced because every move runs into memory faster. That is exactly why these recent sessions kept moving and then returning. The environment was not open. It was layered. This point is important enough to repeat. If you go back through earlier charts and restore the old session memory lines, you can see why each new session-based candle keeps appearing where it does. The chart may look complicated when every older reference stays visible. But once those prior session levels are restored, the placements stop looking random. The March 30th and March 31st structures did not appear in fresh territory. They appeared where prior sessions had already defined acceptance, failure, or return. That is the real use of session memory. It tells you where the next session is most likely to inherit friction. Now bring in volatility. The white Bollinger structure is wide enough to show that movement still exists. But the important detail is not that candles move. It is that volatility does not create lasting distance from the session center. The chart expands, then pulls back. Expands again, then pulls back again. That means volatility is active, but containment is still active too. Now position. Price is not establishing a stable location away from the center. It keeps rotating back through the same band of session overlap. That means location is unresolved. Now interaction. This is where the chart becomes clear. The upper boundary of the March 27th U.S. session. The upper boundary of the March 30th Asia session. The upper boundary of the March 29th Asia session. The lower boundary of the March 30th U.S. session. These are not isolated references anymore. They are stacked. And when structure stacks near the same price area, reaction speed increases. Continuation gets interrupted faster. Retracements deepen before stabilizing. And tolerance narrows. Now pressure. Pressure here is not clean trend pressure. It is rotational pressure around a structural center. That is why two consecutive opportunities could be seen on March 31st without needing prediction. The same compression zone kept exposing both edges. When price tested one boundary and failed to persist, the other side of the same box became active. Then the reverse happened again. Not because of signal, because of structure. If overlap keeps dominating around weekly 0.33, distance remains limited. If one side begins holding outside this overlap, then the environment changes. But for now, the chart is still processing back through memory. Now start with the March 30th U.S. session. This session formed across the upper boundary of the March 3rd U.S. session box. That placement matters immediately, because price was not forming in open ground. It was forming on a previously defined higher structure. And when a session forms across an older U.S. session boundary, the first question is never direction. The first question is whether that older boundary can hold its structure again. What happened next is clear on the chart. After formation, price moved lower. It broke below the March 30th U.S. session box. Then it continued toward the lower boundary of the March 3rd U.S. session box. That sequence shows relocation inside an older structure, not fresh expansion into empty space. Time shows a move from the upper region of inherited structure toward its lower region. Volatility shows directional release during that move. Position shifts from upper testing back into lower containment. Interaction increases because the March 3rd U.S. session box is not just one level. It is an entire memory zone with upper and lower references. Pressure becomes one-sided during the drop. But even there, the drop is still moving into prior memory, not away from all memory. That distinction matters, because a move into memory behaves differently from a move away from memory. When price moves into memory, reaction can appear quickly. And that is exactly what happened next. Now move to the March 30th Asia session. This is where the chart becomes even more important. The March 30th Asia session formed near the upper boundary of the March 27th U.S. session box. And that level is almost aligned with the upper boundary of the March 29th Asia session box as well. That means the session did not begin from random recovery. It began from a stacked memory point, a place where earlier sessions had already shown repeated interaction. From there, price moved upward. It broke above its own structure and tested the upper region of the March 30th U.S. session. That was a real displacement attempt. But not every displacement changes the environment. Only persistence changes the environment. And here, persistence did not hold. Price failed near the upper side and then moved lower again. It dropped through the middle to lower area of the March 30th U.S. session. Then it returned to test the lower boundary of the March 27th U.S. session box. That return is one of the clearest examples of memory friction on the chart. The move up looked real. The move down looked real too. But both moves were still being governed by the same overlapping session memory. That is the point. The market was not choosing new space. It was recycling old space. This is where the phrase trading back inside becomes structurally useful. Price kept leaving a local range only to be pulled back into the larger overlap zone. That overlap zone was being defined by repeated alignment across March 27th, March 29th, March 30th, and then March 31st. Now return to the two consecutive opportunities the user referred to. The safer way to describe them is not as certainty or signal. The better way is to describe them as repeated exposure of the same compression edges. On March 31st, because the session formed between a stacked upper memory point and a stacked lower memory point, the box itself became a working friction zone. If one side of that box was tested without persistence, the opposite side became active again. Then, once the opposite side was tested, the same conditional logic applied in reverse. That is not prediction. It is repeated behavioral consequence inside a compression box. Now bring back the 5 axes together. Time says sessions are inheriting structure from prior sessions. Volatility says movement exists, but it keeps returning into overlap. Position says price is not maintaining stable distance from the center. Interaction says boundaries are stacked and active. Pressure says neither side is sustaining clean continuation yet. If this overlap persists, reaction speed remains high and distance tolerance stays narrow. If one side begins to hold outside the stacked memory zone, then this whole behavior changes. But during March 30th, the chart still belonged to memory first. Now move to March 31st. This is where the chart explains itself. The March 31st U.S. session formed exactly between two already active references. Above was the upper boundary of the March 30th Asia session box. That same region also aligned with the upper boundary of the March 27th U.S. session and with other recent session references nearby. Below was the lower boundary of the March 30th U.S. session box. This means the new U.S. session did not form in a neutral place. It formed inside a stacked compression zone. And the location of that compression zone matters even more because it sits around the weekly 0.33 area. So this is not just intraday overlap. This is intraday overlap around a higher timeframe structural center. That is why this area keeps producing return behavior. Once the March 31st U.S. session formed, price tested the lower boundary of the March 30th U.S. session box. Then it tested the upper side as well. This is the exact behavior that defines a compression environment. One side is touched. Persistence fails. The opposite side becomes active. Then the process repeats. This is where someone closely following the session framework could identify two consecutive condition-based opportunities. Not because the chart gave a signal, not because outcome was guaranteed, but because the session box itself was formed from stacked memory above and below. That structure created a narrow tolerance zone. In narrow tolerance zones, failure frequency rises. Continuation attempts stall faster. And price often travels from one exposed edge of the box to the other before deciding anything bigger. That is the practical reading of compression. It is not abstract. It is visible on this chart. Now move to the March 31st Asia session. This session formed across the upper boundary of the March 30th U.S. session box. Again, notice the inheritance. It did not begin somewhere disconnected. It began directly on an already active U.S. session boundary. From there, price continued to process around the March 30th U.S. structure. This tells you the same thing again. The chart is not escaping memory. It is trading back inside it. Time shows session after session being born from older session memory. Volatility shows bursts of movement that still return to overlap. Position shows price holding near the same structural center rather than relocating. Interaction shows repeated engagement at stacked boundaries. Pressure shows alternating control without clean persistence from either side. This is why the comment about earlier charts is important. When older memory lines are removed, new session boxes can appear mysterious. But when those older memory points are restored, the logic becomes visible. Why did the March 30th Asia session begin there? Because that upper boundary was already active. Why did the March 31st U.S. session form exactly there? Because upper memory and lower memory were already compressed together there. Why did the March 31st Asia session continue processing around the March 30th U.S. box? Because the market had not resolved the compression zone yet. This is the repeatable lesson. A session box is rarely independent. It usually sits on inherited memory. And when several inherited memories overlap near a major higher time frame area like weekly 0.33, the box becomes even more important. Not because it predicts outcome, but because it tells you where behavioral consequence is likely to repeat. If price remains trapped around this stacked overlap, then movement continues to rotate back inside the same structure. If one side begins to persist outside the overlap, then the market starts creating real distance. Until then, the center remains the same. And the chart keeps returning there.